You'll remember earlier we spoke about the definition of an asset, the recognition of an asset, and the measurement of an asset. What this is about is there are different measurement bases for an asset. And you need to make two comments here. The first one is you can have initial recognition, and that is when you bring the asset into the books for the first time. Initial recognition. And then we have subsequent measurement. And subsequent measurement is somewhere down the line, the asset needs to be revalued or the value of the asset needs to be reassessed. And in terms of the National Treasury guidance, there are 6 different methods, measurement bases that we can actually use, and those are listed on page 84. So the first one is the historical cost basis. And if I can use an equivalent word for historical cost, that word would be invoice price. So when you buy the asset the first time, you will get an invoice, and the amount on that invoice will be the amount that you initially recognized. The measurement amount, the amount that we put in the books. It is not so easy to understand that in terms of fixed assets. Because sometimes a fixed asset, what we will find with a fixed asset is that we might buy it in London, and then we need to transport it to Cape Town, and then we need to transport it to Malmesbury, then we need to create a cement block, and then we need to attach it. All the costs until you physically start the engine, all of that needs to be capitalized. And that will be capitalized under the historical cost basis. So when we talk about initial recognition and the first measurement, that happens on historical cost. When we change the measurement base, you will frequently see that in the notes, people will say, this asset is valued at the lowest of cost or. And when they talk about that cost, they will normally refer to historical cost. All right. The next cost that I want to cover is second from the bottom, market value. The one method we use most frequently in terms of measuring the value of an asset is called market value. And market value is very easy. If I sell it today, what is the value that I will get for that? It's like if you go to your car and you want to sell your car and somebody makes you an offer, that becomes the market value. You put your house on the market, somebody makes you an offer, depending on the area and the prices that other people are buying and selling for, that becomes your market value. And market value in my mind equals the cash. Cash at the point of sale. Market value. So often you will find that something is valued at the lowest of cost or market value. So if you pay R1 million for your house and the value of your house today is 800,000 rand, the lower of cost or market value will then get the asset valued at the 800,000 rand market value. Lower of cost or market value. The next one I want to cover is realizable value. And it often goes through as net realizable value, NRV. Now what is the difference between NRV and market value? It's very important. If you sell an asset, sometimes there's a cost of selling. If you sell your house, you need to pay the agent. If you sell your car, maybe there's a dealership involved. So net realizable value equals the market value minus the cost. So if we can get that sorted out, then we've got 3 values that is very easy for us to understand. It's either what did you pay for it initially, what can you get for it now, or the more realistic one is, what is the net realizable value after we have deducted all the costs. The fourth one that is important is called the current replacement cost. Now the current replacement cost is important in 2 areas of business. The one is if you insure your TV at the current replacement cost, then it means if somebody would steal it, the insurance company will replace your TV irrespective of the cost, because you have been insured for replacement cost. And that means, give me a new TV. Same brand, same model, And often you'll find that it's even better model than the one that you have, okay, because of price differences. So current replacement cost is important for insurance purposes, but it's also important in government. Because if you look at inventory in government, then you find that inventory is measured at the lowest of cost and current replacement cost. Not cost and market value, current replacement cost. Why would they do it that way? See, in government, when we have medicines in the hospitals, we don't sell it. So what's the market value of medicines? 0. So now if we need to decide, we need to put a value to inventory. If we use the formula, lowest of cost or market value, cost might be 1,000 Rand, market value 0, then we need to put it at 0. So therefore, what we are using in government is current replacement cost. Is what did you pay for it initially? 1,000 Rand? If you need to replace it today, and today it's 800 Rand, you need to put it at lowest of cost, 1,000 Rand, or current replacement cost, 800 Rand. Okay, and that is fairly unique in South Africa in the public sectors, that when we use an asset for service potential, not generating economic activity and economic benefit, then we use the current replacement cost. The next one, valuation or measurement basis, is called present value. And this is a very difficult one to calculate. It's a cost accounting calculation, management accounting calculation, and what it focuses on is the future cash flows of this specific asset. So it will look at the rent that you will receive from a flat or a dwelling for the next 10 years, and it will take those future cash flows and discount it back to today's value. And you can use a discounting rate like the inflation rate for that discounting rate, or various other rates that are possible. But when we calculate the present value, it's actually about discounting the future cash flows back to today's value, present value. Where will we use that? Any income generating asset. If you have an asset like sanitation works, might be a very good asset where you can actually use present value. Toll roads can be another example where we can use present value to actually calculate the real value of the asset. The last method is called the fair value. So fair value is a little bit different from market value. Many years ago in municipalities, we did not use a balance sheet. We didn't have a balance sheet. All capital expenses were actually expensed through the income statement. Credit cash, debit expense. Then somewhere around 2000, 2001, with the MFMA, we started preparing statements of financial position, balance sheets. Then we started recording assets. And some of those assets, we might have procured them 30 years ago. And now we need to bring them onto the books. So now it's very difficult to put a value to that asset, because the paperwork is long gone, the asset's been depreciated or the asset appreciated over time. So how do we attach a value to that? And this method of fair value was actually identified, where through various ways we'll try to get specialists in that specific field, and those specialists will put a value to the asset. And the moment that we have a value, that value is called fair value. It's a reasonable estimate of the market value at the time, but it's not as clear-cut. It's not as specific as market value. It's an estimation. It's people's judgment is involved because of the age of the asset or the previous price that we paid for the asset. So what is important with fair value? That is also the one that leads to the most issues between ourselves and the AG. Why? Because the AG sometimes disagrees with our fair value calculation. The AG might think that fair value is something else. Based on their experience in 250 other municipalities, they might have a different perception of what fair value can be. And sometimes you'll find that in the audit report, the AG will come forward and say, you know what, we disagree with the fair value, and they want you to adjust that fair value. And if you don't adjust it, it might lead to a qualification if the difference is material. You remember we just covered materiality. So fair value is a difficult thing. I often explain to people that attend the class, I say, you know what, if you want to see fair value, You need to go to the website of one of the painters here in Western Cape, a guy with the name of Robert Scott. And what he does is he actually paints pictures that looks like stock monkeys. You know, these little creatures, it looks like, you know, grade 5 type drawing. And if I would show you one of those drawings, you would say, and I would ask you, what would you pay for that? Most of you would offer 10 Rand. Now some of you would say, if you give me 10 Rand, I'll take it. Eh? If you look at the picture, you might not recognize the value. And even so, his paintings are selling 200,000, 10,000, 30,000, 80,000. Obviously, somebody else sees value in that painting, and they are willing to pay 30 or 50,000 Rand for a painting that you might not be willing to buy for 10 Rand. And that is where the principle of fair value comes in. Fair value is a perception. It is based on some sort of backup, some sort of scientific proof, some sort of market-related proof, but it's not that easy. And that is why the AG might look at an asset and say, we disagree on the value. I don't have numbers attached to this, but I can just imagine government owns many paintings, pre-94, post-94 paintings, and statues, pre-94, post-94. What will Cecil John Rhodes' statue at the UCT campus, what will that be worth today? If you talk to Julius, he says, it's nothing, we need to pull it down and demolish it. You talk to Cecil John Rhodes' ancestry, they would talk about a different value. So how do you put a value to that statue? Each to his own, different perceptions. If you are the AG, you now need to determine what is the real value. Do you listen to Julius or do you listen to the other side of the story? How do we get to that reliable middle road, fair value? All right. So when we look at these 6 methods that we've just covered now, the first one, historical cost, that's the one we use at initial measurement. Most of the others, we use that at subsequent measurement, later on. And every single year end, we will revisit the values. And we will apply one of those methods to determine what is the value of assets at the end of the financial year. If you turn around, you will see that subsequent measurement will occur if it is necessary to ensure that assets measured at historical cost are carried at the lower of cost and a recoverable amount. So that means we can no longer rely on the historical cost as the only measurement of value at the point in time. Values have changed now. We can also rely on or use subsequent measurement if it's necessary to ensure that monetary items denominated in foreign currencies are carried at amounts based on prevailing exchange rates at the reporting date. If you look at the currency at the moment, it's just a while back, the euro was 1 to 15. Now the euro is 1 to 19. So if you have assets or liabilities that you procured in using a foreign exchange rate, can you see the value has suddenly changed? The value might have been increased if it's an asset in a foreign country because suddenly the value is higher. And if it's a liability, you now need to pay more if it was denominated in South African rands. Okay. So it's not only the value of the asset changing, it's also the cash flows that will be attached to that asset that might flow, or the foreign exchange and currency rates that might be applicable at the time. And then the third one is assets and liabilities measured on the current replacement cost are carried at the prevailing current replacement values at the reporting dates. And that is more or less referring to the inventory example that we have used a little bit earlier. How do you choose between these methods? Okay, it's also a little bit of each to his own. If you look at paragraph 5614, which ones do you use? In a municipality, and I'm just going to give you examples for each of them. In a municipality, we'll probably find that market value will be used for all land and buildings. Land and buildings appreciate over time. Municipalities would like to revalue that appreciation, and because of the revaluation, there will be a reserve on the other side. The property is valued more, and that reserve will make out part of a net asset value, and it will push up your net asset value. It's the same for you and me. Every 5 years, we need to revalue our house. Why? Because the value goes up. What does that do to your net asset value? It pushes up your net asset value. So for PPE and specifically for land and buildings, I think we will use market value. Present value will talk about any asset that is income generating. So that can be something like roads, sanitation works. And in the private sector, you might value a coffee shop by using the present value method. Okay. Current replacement cost, I've already covered that. That is inventory. Fair value, any asset where we do not have a very clear-cut historical cost. Fair value. Okay. And over time, I think fair value will be used less and less. All right. Any questions on that?